In this video, what we want to do is have a look at how we calculate tax on incomes in Australia. So people earn incomes in Australia and they obviously have to pay income tax because the country needs to work. So we have to have a way of working it out. Now this table comes from the Australian Tax Office website, so which you can go to ato.gov.au, and it shows you what the current rates are, so what people will be paying this current year. So these tax rates apply from the 1st July 2014. So, and the taxation is paid for the financial year, and that started at the 1st of July 2014 and will end at 30th of June in 2015. So that's where we call it the financial year. So it's different to a normal year, and we work in that way. Now, what Australia has on income tax is what's called a progressive taxation system. And as you can see, there's different, depending on your different outcomes, you will pay different taxes. Now, we've got to be careful. There's a number of misconceptions we don't want you to have. And be careful, and I'll explain that as we go through the video, but you've got to be careful to say that people that earn a lot of money don't pay, they pay same tax on earlier amounts as these people would do if they're only earning small amounts. And what do we mean by that? So basically, if you earn less than $18,200, so well, basically everybody in Australia who earns their first $18,200 in income every financial year pays no tax. So nil means no tax. So the first 18,200, so whether you might only get $10,000 or you might be earning $200,000, that first 18,200 you pay no tax on that. So you get that free, basically. That's gone up over the years because people are starting to earn more money. So it used to be for a long time only about $6,000, which was not really fair on those poor people who didn't make much money. A lot of people who are working full time would earn much more than $18,200. But also it's good for younger people who are only working part-time jobs, that they don't get unfairly taxed because they're not making too much money. They're probably not making over the 18,200. Once you do start making more than that, so for every dollar you make over $18,000 to $18,200, but less than $37,000, every dollar there you pay 19 cents in tax. So if you made $18,201 in a year, you'd pay 19 cents in tax because you made $1. If you had made $18,202, you'd pay 38 cents in tax because that was $2 over the 18,200. So you'd have to pay 19 cents for every dollar there. So that goes all the way up to 37,000. And if you do get $37,000, then you would actually pay $3,572 in tax, because that's the top. That's how much. If you took $37,000 and took away the first 18,200, and what you had left over, you'd pay 0.19 of that, or 19 cents in for every dollar. So let's have another example of how that would exactly work. So let's have a look. If you made $22,000. If you made $22,000, your first $18,200 is free. So what we need to do then is go, well, how much more than $18,200 do you make? We'll subtract that from 22,000, gives you $3,800. And then what we do is we say, well, that's how much income we're going to have to be able to tax, and that would be 0.19 of the 3,800, which would give us an income of a taxable amount of tax payable of $722. So that's how much tax you would pay. Not too much, but you're paying a little bit. You're earning a little bit over what we call the tax-free threshold. So you are going to have to pay some tax. So as I said, if you made $37,000, you'd pay $3,572. And then though, if you're earning more than that, every dollar you earn over $37,000, you're going to pay 32.5 cents for every dollar there. So if you say made $42,000, well, you'd pay this amount, and then the 5,000 is the 42,000 is 5,000 more than 37,000. So we'd pay 5,000 times 32.5 cents, and that would give you the amount of dollars or cents you'd have to pay. If you earned up to $80,000, you'd pay $17,547 in tax. But the bad news, if you're earning more than that, then you start to pay more tax. For every dollar after that, you start to pay 37 cents. So, and that goes all the way up to 180,000. So once you've got earning $180,000, you pay $54,547 in tax, but you'll also pay after that 45 cents for every dollar over 180,000. So you can see how it progresses. So the more money you start to earn, the higher tax bracket your higher income starts to be put into. Remember, it's only the money that's over $180,000 gets taxed at 45 cents. The rest of that, the first $180,000 gets taxed at these lower levels. And as we said, doesn't matter whether you're making the 18,200 or 180,000. That first 18,200 is free. So another example, let's pick one where someone's earning $100,000. So if they're earning $100,000, that would mean they're in this second last tax bracket, and they were earning $20,000 over the $80,000. So for first $80,000 they earn, they get $17,547. That's how much they have to pay in tax, and it's only the last $20,000 then gets taxed at 37 cents in that dollar. So we put the 0.37 times 20,000, add it to the 17,547, and the tax payable for someone earning $100,000 is 24,947. So people pay their fair share if they have nice jobs where they're earning this large amounts of money. Well, they're doing very well, but also they have to start paying more tax. But this is what we call taxable income. Now, later on, we'll work out exactly what we mean by taxable income. So it might not be the income you get, because you can take deductions and we can work that out. But there's another that's another video we can look at to work out what taxable income is. But this is just to work out those rates. Just another note: make sure we don't include our Medicare levy in that, because that gets calculated separately as well. So again, another time we'll work out how do we work out that, and we'll show you how to work out that Medicare levy and what income that is taken on in the Australian tax system.